All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our midweek options update. Wanted to jump on here, walk you through some of our trades that we've closed out over the past few days. It's been a very active week for us. A lot going on. A lot of trades have been closed out. We do have some capital that we need to put to work here over the next few days. So I'll also highlight some trades that are on our radar for the second half of this week. As always, if you have any questions that I can help with, feel free to email me directly, mike@netpicks.com. You can always leave a comment here inside of the live session, or if you're watching the recording, post a comment on the recording on the video on Facebook or YouTube, and we'll get back with you right away. All right, so a very interesting last couple of days. Going back into last week, this is the daily chart of SPY, and you can see there's been a number of cases where we have tested very key support levels. These are levels that we've talked about over the previous few weeks, right? We've been talking about the 8-period EMA. That's that solid pink line up at the top of the chart. We then talk about the green lines. Those are the 20-period simple and exponential moving averages. We have tested those numerous times over the past week, and every single time we test these key support levels, price action recovers very quickly. We're getting every dip bought yet again. Go back to yesterday's session. Early in the session, it looked really nasty, led by the NASDAQ on the downside. We were breaking those support levels, but look what happened the rest of the day. We recovered, closed back above the 20 EMA and SMA. As a result, the bulls took back control. Fast forward 24 hours, we saw another case this morning where bonds caused equity to sell off yet again. Down near the lows of the session, mid-morning, buy the dippers stepped back in, and we closed right up at the high tick of the session here today, right at 391.77 on SPY. We are right back up, essentially right up near that all-time high. The all-time high is up just above 394. Over the next few days, you have to expect another push back to the upside, at least to attempt that new all-time high. I'd be very surprised if that did not happen. Again, like I've talked about, everybody's expecting the S&P to move up and touch 4,000. We're less than 100 points away from that level. That's very doable yet this week if we continue this rally on the upside. The volume has definitely kicked in, and that makes perfect sense. We have seen volume so far this week above 70 million shares. That's right in that range that we've talked about here previously. We want to see that range in that 70 to 100 million share range. We've got that here this week because we've had some different rounds of selling. Now, we haven't seen any follow through as of yet, but it is good to get some back and forth movement. That's ideal for us as options traders. We don't want the one-way movement. I want to have back and forth movement. I don't need the market to collapse. When I talk about looking for a market pullback, that does not mean I am expecting a complete washout move to the downside. We don't need it. The last few days has been enough for us to book some really nice profit. The back and forth movement is what we need. And I would expect that to continue here in the days and weeks to come. So where does that leave us for the rest of the week? Again, all-time high at 394.17. That is the next area up above as a resistance. Above that, we're looking at 395, 396, those big round numbers on the way up to 400. On the downside, we clearly know, after the last week, we clearly know where the support levels are at. We've got the 8 EMA. We have the 20-period moving averages, both the simple and the exponential. So we've got this area of support between 385 and 390. Until those levels break, we're just going to continue to see a lot of these dips bought up. Again, volume definitely has been increasing, which is good. The ATR, which is the indicator down at the bottom, the average true range, has upticked. Even though the market has rallied back higher, the ATR has moved back up, approaching 5 again. That's the key number for us. I want to see that number at or above 5. When we start to see the ATR in that type of a range, it indicates better price action, better movement for us to work with. As we start to get back down below 4, that's when things start to dry up, and that's when it starts to get more difficult intraday to get the movement that we're looking for. The VIX is still above 20. That 20 handle just continues to be a rock solid support level on volatility. So even though the market's back up near the highs, we continue to see that VIX staying above 20, a 21.34 at the close here today. All right, so let's talk through some of the overnight pop trades. Sorry, guys, I'm just trying to check questions here. All right, let's go ahead and take a look at some of the overnight pop trades. These continue to be really great performers for us. The overnight pop trades, we've had 8 winners in a row over the past 2.5 weeks. The NASDAQ Option Superstars program, we have closed out of 18 winners in a row. The two-way price action has been very, very good to us, and no doubt about it. Well, yesterday afternoon, we put 2 different overnight pop trades on, one with our overnight pop trade service and one with our ETF Option Superstars program. We're going to talk about our overnight pop trade from our overnight pop trade service here first. And what we did yesterday afternoon, we always put these overnight trades on during the last 30 minutes of the trading day. These are trades that we are looking to open right before the close, the day before expiration, and then we close these positions out the morning of expiration day, typically in the first 60 to 90 minutes of the session. And what we did is, because this market was overdone, we did get oversold on the downside, and we saw that bounce yesterday pretty much all afternoon. What we decided to do is to sell an out-of-the-money put spread. That is a neutral to bullish position. And what we did is we sold the 387, 385 put spread, meaning I'm selling the 387 put and I'm buying the 385 put at the same time. This is a neutral to bullish position where we want SPY to stay above 387. Okay, these are the options that expired here at the end of the day today. The trouble here was, first thing this morning, we saw the bond market go berserk, and that caused a sell-off in equities. And immediately this morning, this trade was down money. And let me pull up the 5-minute chart here of SPY so you can see what I'm talking about. So on SPY, first thing this morning, the market did not look good in this section right here. Okay, we opened lower, and during the first 30 minutes of the session, it looked like we were ready to break some support levels, and it looked like we were going to see another wave to the downside. Well, because of that, it had me looking to close out of our overnight pop trade as soon as possible. And once we found support here, right on top of this pivot, right around 10, just after 10 o'clock, we saw a bounce. And on this move to the upside, we looked to close out of our trade. And what we did is we closed out of the trade. We opened the trade yesterday. Let me get my spreadsheet up. We opened the spread yesterday for 52 cents. We collected $52 per spread. It required $148 of capital per spread to put the trade on. That was the most I can lose on the trade. I'll talk about that more in just a moment. And this morning, we closed the trade out for 43 cents. It gave us a small $9 profit per spread. Okay, it was a 6% return on our capital overnight. Why did I close out of this trade? I had a number of questions come in from people. Why didn't I hold on longer? We could have booked a full profit come into the day. Because of that 5-minute chart that we were looking at this morning, this market did not look good. We were dead wrong. We were way underwater first thing right at the opening bell this morning. When I was able to close this out for a partial profit, I definitely took advantage of that opportunity. I did not want to hold and then have the market sell right back off, move back down to the lows, and then take a full loss on the trade. With these overnight pop trades, we've got to take action relatively quickly. These are not trades that we're going to hold for any length of time. Clearly, you can see the spread down at the bottom. It would have expired worthless. Had we held to the end of the day, we would have been able to take the full profit. It just required too much risk. Granted, we did get a one-way move all afternoon. Market-wide, we saw very little weakness the rest of the day. So, it's always that hindsight game, right? Hindsight's always 20/20, and we always have to fight that as a trader. It was still the right decision this morning to close out of the trade. Because we recovered, we went from a losing trade to a profit. We wanted to take advantage of that, take the risk off the trade, and move on to the next position. So it wasn't a huge profit, right? I mean, it's a very small profit, 6% return on our capital. But the reason I love this trade is we were dead wrong. We did not get the initial move that we were looking for first thing this morning. And yet we were still able to book a profit. So I love how forgiving these trade types are. So it was a nice winning trade. I did talk to a few of our members that were able to book larger winners, and that's great. I took the partial profit myself mid-morning. The second trade that we put on yesterday afternoon was on SPY as well. And we put on an iron condor. And what that means is I'm selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. What we did is we sold the 391, 393 call spread, and then we sold the 384, 382 put spread at the same time. The goal of this trade is we wanted SPY to stay in between 384 and 391. Those are the strike prices of the options that we sold. As long as price stayed in between that range, we were going to be able to book a profit. We make money from that time decay adding up. Well, just like the earlier trade that we talked about, we were able to close this one out mid-morning as well. We opened up the position for 52 cents. We collected $52 per spread yesterday afternoon. We ended up closing out of the trade for 24 cents here this morning, mid-morning. That gave us a $28 profit. It was a 19% return on our capital overnight. Again, did we get the movement that we were looking for this morning? We really didn't. Okay, we are expecting more of a slow, methodical move higher right at the open. We didn't get that. We saw a very active move right at the open. So we're dead wrong on our directional outlook, and we were still able to book a profit. That's why I love using these overnight trades with the credit spreads. They do allow us to recover much quicker, even when things don't develop like we anticipate. Okay, so a really nice trade there on the Iron Condor as well. Now, I've had some questions come in on the risk side. Some of you have been looking at these trades and you're saying, okay, if we put on the spread, let's just talk about the put spread yesterday. We collected 52 cents or $52 per spread to put the trade on. I was risking $148 per spread. That $148 is the most I can lose on the trade if I am dead wrong. The tricky part, and what's a little bit misleading for some people initially, is you look at that and say, okay, if I'm risking $148 to make 52, how does that make sense? One losing trade is going to wipe out multiple winners. Keep in mind, the $148 of risk that we had on the trade, that's the most I can lose. And the only way that I can lose that entire investment is if I hold all the way up to expiration and the trade moves against me. We do not hold to expiration. It's something that we will rarely do. I can't remember the last time we held an overnight pop trade to expiration. We will always close out of the trade early. And even on those trades that move against us, we're going to be able to take a partial loss. Most of our losing trades, when they go against us with an overnight pop trade, we're going to be in the 30 to 60% range. So we're not going to take that full loss. One losing trade is not going to wipe out a whole string of winners. So that's what helps get the numbers in our favor. When you start to combine that with our winning percentage is now 75% going back to last year. That's the formula that we take advantage of. That's what's going to allow us to continue to book the profits and continue to grow the account over time. So wanted to clear that up. Had a number of questions come in here over the past week or two on the risk reward ratio on the credit spreads. We will be looking for our next round of overnight trades tomorrow afternoon. With the overnight trades, we look for them every Monday, Wednesday, Friday on SPY. SPY does have 3 expiration cycles every week. And then Thursday afternoon going into Friday, any stock or ETF that has weekly options is fair game. So tomorrow afternoon, we'll be looking for another trade on SPY, and then any other product, Apple, Facebook, Netflix, Tesla, any product that has a weekly option is fair game for us tomorrow. So we'll be very active again tomorrow afternoon, looking for at least 1 or 2 new trades going into Friday's expiration. Right. And let me get a link into the chat for you guys. Just give me a quick second, because we are going to be doing another live webinar here tomorrow. Some of you were able to join us here last week. Last Thursday afternoon, we actually came on, did a live session, and actually released 2 trades in real time. Those 2 trades ended up being really nice winners for us Friday morning. So we released those free of charge. We're going to do another one of those sessions here tomorrow afternoon. And I just put a link up on the screen. It's netpicks.com/poplive. So /POPLIVE. Go ahead and visit that link, sign up. It's a very free webinar tomorrow afternoon. We're going to be talking about those overnight trades in real time. So trades that you can piggyback off of going into Friday's expiration. So we'd love to have you join us. Again, I'll just leave that link up on the screen for another few minutes That way you can go ahead and click on it, type it in, and we'll be able to get you a spot reserved for that free webinar tomorrow afternoon. It will be at 3 p.m. Eastern time. All right. Now let's talk through, let me bring up our 195-minute charts. This is the chart that we base a lot of our entry and exit points off of. And let's talk about the index products, where we stand going into the end of the week. Notice here on SPY, this is the S&P 500 ETF. That earlier sell-off that we saw earlier in the week came down, tested the white and yellow line. That's the 50-period exponential moving average. Found support there, and we've been zooming right back to the upside. So we actually do have a new long setup that is plotting for us. I'm very cautious on the long side here. I mean, clearly the bulls are in control of this market. There's no debating that at this point. Every single dip has been bought up immediately. But we still have a market that is very extended long-term. We've basically spent the last 12 months pounding our way to the upside, and we're right back up near all-time highs. I'm not opposed to putting on new bullish positions here, but if I'm going to do so, I'm going to do so with smaller risk. If I can cut my position size from normal, I will do so. I'm also interested in more vertical spreads at this point. If I'm going to put on bullish trades, I want to cut back a little bit. Not saying the market can't head higher. It's tired here. I mean, there's just been some extreme moves on the upside. So if you're looking at this long setup, we do have this entry point. It's there. It's this blue plus sign. That entry point is there because our trend strength histogram down at the bottom went from red to blue, indicating bullish momentum staying in control there. Our entry point at 391.55, that entry point did trigger in today. Where does that put our target at? Normally, when I put on a bullish position with a long call or a long call spread, I am looking to double my money. My initial target is a 100% return, while my risk is 50% of whatever I pay for that option. Okay, so with our entry at 391.55, let's talk about that over on the trade page. If we open up, I have been looking at a lot of April monthly options at this point. Going out 51 days is a little bit longer than what we typically go. I'm typically in that 30 to 60 day window. So we're towards the longer end of that range. And if we take a look at a long call, the problem here is when you start to go out 51 days, the options, they're expensive. They're pricey, right? If you come in and take a look at buying a long call option, let's just say we go to the 391 call, you're talking about over $1,000 per contract. They're expensive. It's not a deal breaker. If you've got an account size that can handle the risk, perfectly fine with that approach. But if it's too expensive, what we could also do is turn this into a call spread, turn this into a vertical spread. I could right click on that 391 call, go to buy and go to vertical. That's going to pop up an order down at the bottom where I am still buying the 391 call, but now let's take a look at selling an out of the money call as well. Let's go ahead and take a look at selling the 397 call. It would put on a $6 call spread, $6 wide call spread, buying the 391 call, selling the 397 call. It's still a bullish position. I still want SPY to move to the upside, but I drastically reduce the cost of the trade. And if we just buy the long call, we're talking about over $1,000 a contract. By putting on the call spread, we're able to lower the cost down to $340. Much less risk, much safer play, just in case this market does decide to reverse again over the next few days. Okay, so that's another bullish trade that you could put on SPY. Either way, they're both bullish positions. We manage to trade the same way. Both of them need SPY to move to the upside. QQQ, looking at the NASDAQ ETF. Go ahead and pop this one up here a second. The NASDAQ has been in a short trade. We did go into a bearish mode here back on, I'll show it to you right here. Our trend strength histogram flipped bearish back on February 19th. This candle right here. And we did get a nice wave to the downside. Okay, we moved from a low at 329.97. We moved all the way down to around 311. I mean, that's a pretty nice push to the downside. There's a lot of profit in this move to the downside. We are now seeing price action bounce higher. So where does that leave us? Notice how price action is approaching the 8-period EMA. That's that blue and red line there on my chart. We're going to wait and see, do we get any type of resistance here? Do we see price action stall out and reverse back to the downside? right? So at this point, I am not looking for anything new on QQQ. I'm going to hold off here for the next few days. We'll revisit this one on Friday, see if there's anything new developing, see if there's any new trade opportunities there. But for the time being, nothing new on QQQ. IWM, the Russell 2000 ETF. Just like SPY, it's been rock solid. It's been super strong here. All dips have been bought, and we did get another new long setup here with an entry point at 227.34. Everything I just got done talking about on SPY holds true here on IWM as well. We're cautiously bullish. I'm not looking to jump in with both feet and say, I'm going to put everything I've got into new bullish trades. Want to keep it small. What I am looking at on these long trades is using around 50% of my normal position size. And I'm also taking a look at those vertical spreads, just like we talked about on SPY. That way, I'm still giving myself bullish exposure. I'm just doing so with far less risk. I'm putting on a more conservative trade here on the upside. So cautiously bullish on IWM as well. Let's talk about SLV. This is the silver ETF. We've been talking about this the last few weeks. We've talked about the bullish opportunity that was there. It's still there. We've talked about how SLV went into bullish mode early February. Back around February 4 or 5 is when we went into bullish mode. We've been in bullish mode ever since. Price action has just been straddling the 8 EMA the last number of weeks, last 2-3 weeks. We are still bullish. We are still looking for a break to the upside. SLV was up almost 1% today, so it's another good day for silver, but now we need that follow through. That's been the missing piece. Every time we get these sessions where we rally up, 1% like we did today, we sell off the next day. So I want to see SLV follow through on the upside over the next few days. I am still in a long call position on SLV, looking for a further move to the upside. And then AMD, this is Advanced Micro Devices. This is a trade that we put on here earlier in the week. We put it on here yesterday. So AMD, we did get oversold. How do I quantify that? Notice on the 195-minute chart, the pulse indicator down at the bottom, we see the yellow bars and then the one green bar from earlier in the week. Those indicate price being between a 1 and a 2 standard deviation move on the downside. In other words, we're oversold. It will typically lead to either a period of consolidation or a reversal in the other direction. Every time you can take a look, go back over the past couple of months. Every time we get those extremes, every time we get those yellow bars in the pulse, it will lead to that sideways stretch or even a reversal. We saw it back late January. We saw the oversold condition led to a bounce to the upside. Fast forward to current markets, we're oversold. We have those yellow bars again. Like what's happened the last couple of days. We've started to bounce back higher. So what we did, based on this chart pattern, looking for that period of consolidation or a reversal higher, we decided to sell an out of the money put spread. And what we did is we went out to the April monthly options, the ones with 51 days left. Let's switch to AMD. And we decided to sell an out of the money put spread. We went to the 77.5 puts. I right clicked, went to sell and went to vertical. We sold the 77.5 put and we bought the 75 put at the same time. This is a neutral to bullish position. I want AMD to stay above 77.5. It closed today right around 87. We've got almost a $10 cushion now where AMD could move against us to the downside and we're still okay. The only move that hurts us is a big move below 77.5. So far, so good on this trade. We opened it up for around 76 cents. Yesterday, we collected $76 per spread. It tied up $174 of our capital. You could still put the trade on. You'd want to get filled at 65 cents or higher. At the close today, it was trading for 63 cents. So we'd have to wait. You'd have to wait to see if that spread gets back up to 65 cents here tomorrow. In order for that to happen, we would need to move lower on AMD tomorrow. So let me go ahead and change the price to our fill price from yesterday so you can see the risk reward on this trade. So here it is. We're risking $174 to make 76. We have 5 ways of making money on this trade. We make money if the stock moves up, down, or sideways. Doesn't matter to us as long as price stays above 77.5. We also make money from time decay adding up and from volatility decreasing. So there's 5 ways of making money on the position. So we'll continue to track this one here over the next few weeks. So as you can see from the trades I've talked about today, we've taken some overnight pop trades here this week. Those continue to do really well for us. We've had 8 winners in a row there. We have used some of the April monthly options. We talked about long calls on SLV, a long call spread, or a long call on SPY. And now we're talking about selling a put spread on AMD. The reason I point this out, what I'm trying to get across to a lot of people right now, diversification is crucial. And you can diversify multiple different ways. Yes, with the products that you trade. We've taken a look at some ETFs. We've taken a look at some individual stocks. We've mixed up our expiration cycles. We looked at some weekly options and some monthly options and mixing up those strategies as well. The more layers of diversification you can put into your trading, the better off your results will be long-term. I continue to talk to so many people right now that are just strictly limiting themselves to buying calls and puts. And then they come to me and say, hey, Mike, I'm just not making money. I'm not making money on a consistent basis. And there's a reason for that. The long calls and long puts are the most aggressive strategies you can use. I'm not saying you shouldn't use those, but you don't want to do so exclusively. Diversify, mix it up a little bit. You're going to be far better off taking that approach long-term. So I'm going to continue to highlight those strategies here. I would love to connect if you have any questions or would like more details on the strategies that we've talked about here in these recent videos. Let me know. I'm more than willing to connect for a phone call and we can see if we can get a plan in place for you to get more consistency in your results. The AMD trade that we talked about here today, this was part of our NASDAQ Option Superstars program. And that one has had 18 winners in a row. So price action has been very, very good to us here of late. All right, so if you have any questions on any markets that I have not taken a look at here today, feel free to type those in. I'll do my best to give you some feedback there. Otherwise, get that banner up one more time. The link on the bottom of the screen. We'd love to have you join us for a free webinar here tomorrow afternoon, 3 p.m. Eastern. Go ahead and click on the link or type in this link, netpicks.com/pop live. We'll get you a seat reserved. We're just going to show you in real time how we take those overnight pop trades. We review them in these weekly review sessions. But tomorrow, we're actually going to walk you through trades that we're taking live with our members. So we'd love to have you join us tomorrow at 3 p.m. All right. I will be back also on Friday for our next live recap session. I'll be back right around midday is the goal. It just depends on how busy the day is. But we'd love to have you join us on Friday as we wrap up the week. All right. So enjoy your evening, everybody. I'm going to wrap up for today and we'll talk to you guys here. We'd love to see you tomorrow. If not, we'll see you on Friday for our next recap.